Hello, everyone. Thank you all for joining us today for Grenzebach Lear & Associates webinar series presents Sprint for the Finish, using portfolio analysis to finish campaign strong. Co-presented by Joan O'Neill, Associate Vice President for Development at Yale University, and Brian Chapman, Senior Vice President, GG&A Philanthropic Analytics. Joan began her career at Yale in 1987 and in her current role oversees a majority of the individual giving initiatives, including the annual fund, major gifts, reunion, and planned giving. Joan also provides leadership to the fundraising efforts of many of the university's professional schools and programs. Brian joined GG&A in 2006, bringing 20 years experience as consultant, entrepreneur, and government official. In his current role, Brian is responsible for overseeing the firm's benchmarking, peer analysis, performance analytics, and DonorScape prospect analysis projects. In today's session, Joan and Brian will present a case study and observations about how an effort to refocus major gift portfolios can be used to reinvigorate a fundraising effort mid-campaign. Fundraising campaigns start with great enthusiasm, but can hit slow periods as initial donors are still fulfilling pledges and the near-term prospects have already been solicited. Campaigns often need to get refocused to be successful in the crucial final years. Major gift portfolio analysis is being used at Yale University to help refocus staff on the most likely and capable prospects and to ensure development officers were being given the best chance to succeed through refinement of their portfolios. This process is also allowing Yale to move towards greater accountability and forecasting of campaign results through better management of information and reporting. The lessons from the Yale case study are largely applicable to any institution that is in or is contemplating a comprehensive campaign. A question and answer session will take place after the presentation. Please use the chat function on the right-hand side of your screen, select all participants from the drop-down menu, and send Joan and Brian your questions. Please feel free to keep your chat up throughout the presentation and share your thoughts and questions with your fellow attendees. This coming Monday, we will send a recording of the session along with the presentation slides and a short survey to gain your feedback. Thank you again for joining us today, and now I will turn it over to Brian and Joan.
Hello, everyone. This is Brian Chapman. Thank you for joining us today. I want to echo Stephanie's comments and say we really appreciate your taking the time to hear about this case study from Yale University. I'm very pleased to be co-presenting with Joan, who has been living day to day with the Yale campaign and how to make sure that the Yale campaign achieves its greatest possible success, and that this process was a piece of doing that. So we will jump right into it. Let me start by saying that it is GG&A's point of view and continues to be GG&A's point of view that campaigns are an extremely effective organizing mechanism. Time and time again, we see data that suggests that they raise fundraising performance not just during the campaign, but sustainably after the campaign. That said, campaigns do go through cycles, and while the initial enthusiasm and many of the early gifts are being paid off, and before the excitement/terror of the end of the campaign is upon us, there is a potential for a lull period during the central years of a campaign. And what we really want to talk about today is how Yale has used a process of analyzing major gift portfolios as a way to try to refocus attention and effort of the fundraising staff through the course of a long, comprehensive campaign. I think I'm going to turn it over to Joan now to just give a little bit of background on the Yale Tomorrow campaign. Joan?
Thanks, Brian. So we're in the final 15 months of the Yale Tomorrow campaign. This is a $3.5 billion effort, and to date we've been very successful. We've raised, this is January numbers, so they're out of date. Of course, we're well past that now, but we've raised $2.87 billion against that goal. It is a comprehensive campaign involving the entire university, all the schools and units, and Yale's last campaign ended in 1997, so it had been some time since we'd had a campaign. Leading into this effort, we spent considerable time working on the priorities and our feasibility and involved the president and the provost and various deans and directors around campus. The campaign is organized around 4 themes: the college, the arts, the sciences, and the world. And we initially launched the campaign with a $3 billion goal, and things were progressing so well that we, with great confidence, raised the goal in June 2008. Now, of course, when we increased the goal, the economy was booming, and we had anticipated being able to grow the staff significantly. We're kind of going full steam ahead, but the world changed significantly in the fall of 2008. So thankfully, we've been able to continue on a successful path and have stayed ahead of the straight line projection to date, despite the economic slowdown and despite an increased goal. But this did give us a moment to really take stock of where we were, that in addition to an economic slowdown, we were entering, or now find ourselves in, the 4th year of a campaign, and as Brian mentioned, with that often comes some plateauing and fatiguing. So it led us to really try to look at how could we be sure that we were focusing our activities on the highest return activities, and how could we make sure that with the staff that we have, and with an assumption that we would not be going through significant growth in our staff, how could we ensure that we were as successful as possible? And so it was at that point that we became involved with GG+A and got to know Brian.
Thanks, Joan. The concept of what we started with and what really took place at Yale was to say, how do we understand, with the context of 2 years to go in a campaign that has been successful, but we know we need to stay very focused to get to the finish line strong, how do we use analytical tools to examine the value of both assigned and unassigned prospects and understand what that means for how we're deploying staff? Now, value is an important concept to talk about here. In the Yale environment, as in many higher education institutions and healthcare institutions we work with, value was typically defined in terms of pure capacity. If you had assets that suggested the capability of making gifts, that was the primary driver of how we assigned a prospect. But with 2 years to go in a campaign, we also needed to understand who was likely to be a donor during the remainder of the campaign, in addition to who's capable. And so that was part of what the objective of this was to look at value as a function of capacity and likelihood and figure out what that told us about the ways in which we could optimize portfolios. Secondly, we needed a means to evaluate portfolios both within and across the schools and programs on campus. To Joan's point, this was a comprehensive campaign that involved all the different parts of a very diverse institution, and while we had a better handle on some of the things that were happening in central development, we certainly wanted to make sure we were including all the parts of Yale and all the aspects of how development officers were doing their work. And finally, we wanted to build an effective major gift pipeline as a way to understand, as management tools, where were we with the development of prospects and moving them toward making gifts that could affect that $3.5 billion goal. Some of the questions we were trying to address were things as simple to say but as hard to do as, do we have portfolios that are really constructed optimally in terms of, are they the right size? I will tell you from examples of having done this at a number of institutions, the fights over the size of a portfolio are almost impossible to avoid. In reality, it's a big deal to say we want to make portfolios smaller and more focused, and it can really only work if we've been able to deliver to those portfolios the most likely, most capable prospects. So size becomes an issue. Relative value. Do we have the best portfolios in the hands of fundraisers who are best capable of pursuing that potential? And to what extent are we focused on short-term priorities within portfolios and long-term? Because again, if you think about the pressures associated with being mid-campaign, we don't want to ignore the long term because fundraising doesn't stop the day after the campaign ends, but what's the right balance between the short term and the long term in a portfolio? And finally, the question of, are we effectively moving prospects in portfolios toward making gifts within the time frame that we establish as our standard and our best practice is important. In talking to quite a few institutions about this, the consensus is that most performance-based conversations, when a lot of managers sit down with a lot of fundraisers and we talk about what's going on in your portfolio, the conversation tends to focus around the last 3 or 4 weeks and the next 3 or 4 weeks. here are the things that I've been doing very recently, here's what's coming up near term. But when we think about the university or the healthcare institution entrusting 150, 200 prospects to a development officer, in the context of a campaign, we need to understand what's happening across that whole portfolio. What's really moving toward making gifts and what's not. So with that in mind, we established a process that starts with prospect analysis. In order to understand what's happening in a portfolio, we must start by understanding what's happening with a prospect. So some of you have been through quite a few analyses like this, but what we did at Yale was we conducted a predictive modeling analysis on about 155,000 Yale constituents, alumni and donors, to look across the entire university at who appears most likely to be a major gift prospect, who appears most likely to be a large annual giving prospect or a planned giving prospect, and who appears most capable. Now, I want to make a note about the capability and the wealth screening piece. Yale has done a great job of doing research function-based analyses on quite a few prospects. But in order to conduct this kind of an effort, it's really important to have a contemporary view of all 155,000 people. So a broad-based database screening allows us to get a level playing field for looking at large populations. We obviously went back and then checked that against what researchers had developed, and the researchers almost always had a depth and level of understanding of a small number of prospects that a broad-based screening wouldn't have. What we tried to do was coordinate those things. Predictive modeling, in our view, just to make sure people understand what goes into it, is really about understanding this question of who's likely to be a donor so that we can cross that with capability and get at value. And it's really driven by a series of broad categories of things: how people have given to the institution, what kind of relationships they have, and then a variety of external factors like demographics and wealth indicators, and something we use called PRISM, which is a marketing segmentation system that is used very extensively in the private sector to separate you from your money. What we wanted to do was figure out how we can use it in philanthropy to do the same, and it's been very effective for us over a long period of time. But all of these things combine in a predictive modeling exercise to try to answer the question within a broad group of 155,000 people, who's most likely to be responsive to major gift solicitations. This is the output of it, which is a series of ratings. I want to focus you on the right-hand side of it, because for the rest of this presentation, we're going to be focusing largely on major gift and principal gift portfolios, though these principles are applicable in other areas like annual and planned giving. The key terminology that you'll need is that A, B, C, D, E. In Yale's case, every one of those 155,000 people received a major gift rating of an A, B, C, D, or E, and what that's reflective of is who seems the most likely to be responsive for a solicitation. A's, B's, and C's are the top 5% of major gift donors. And when we get to portfolios, we're going to talk a lot about the idea of what's the concentration of A's, B's, and C's, that is near-term donors, versus D's and E's who are long-term potential donors. So we're not suggesting that D's and E's are bad prospects. What we're saying is they're less likely to be supportive in the last 2 years of a campaign. They're certainly worth building the relationships to turn them into long-term donors, assuming they have the capability we're looking for. So A's, B's, and C's versus D's and E's, just keep that concept in mind as we go forward. So the second piece of that, after the predictive modeling is done, is we do wealth screening. And again, that's something most of you are very familiar with. It's looking across national databases of publicly available information to come up with an idea of what kind of capacity people have to make gifts. It's a 1 through a 9, and there's a lot of nuance and science behind it that we don't need to go into in great detail here. But this is getting at the idea that we can place a value on people's capacity and then use that together with inclination to reach value. So here is kind of a key chart. This is university-wide at Yale. The top half of this chart is the assigned prospect. So if I can direct your attention to sort of the middle of the page in the gray bar on the right side, you'll see the number 9,746. That was how many prospects were assigned to development staff at Yale. Across the top, you'll see the A, B, C, D, E, that major gift rating, and down the left-hand side, you'll see the capacity, which is where people were rated in terms of their capability to make a gift. That orange box, maybe it looks red, maybe it looks orange, not sure what color it'll show up as. That box is the group of assigned prospects who are less likely in the near term to be donors, Ds and Es, and have a lower capacity than others. They have capacity of less than $100,000. There were 3,161 prospects who were currently assigned, a little under a third of the assigned prospects at Yale, who look not very near term and not very capable. If you look at the line just below that, you'll see something called unable to rate. Joan will talk about this in a minute, but there's a large group of 2,000 prospects who are currently assigned who simply there wasn't enough publicly available information to understand whether they were highly capable or not highly capable. We didn't take a point of view on those, but Yale actually did some very interesting work looking at that population as well. But so we start with the idea that there's a lot of assigned prospects who don't appear to be as valuable as some other prospects who are represented along the bottom half. That's the unassigned population, and within that group, there were 1,560 households that were A, B, and C rated, that is likely to be responsive to a major gift solicitation, and had capability of $100,000 or more. So we are looking at trade-off decisions between those two boxes. So Joan, can you comment a little bit about sort of how this chart and the concepts behind it were viewed by management and leadership at Yale?
Sure. So I'd say, first of all, we probably weren't surprised by the numbers we saw in the, I always call it orange, but the red box. I think that, as Brian mentioned, our ratings at Yale do not factor in inclination at all. So I think the staff have always felt that they had prospects in their pools that were not a great use of their time, but we didn't really have a process for what to do with these folks. If they were a Yale College prospect and they had a rating, then they were assigned to a major gift officer, for example. So this really gave the staff the license to be able to say these aren't very good prospects and that they should be moving out of my prospect pool. So I think it kind of validated a lot of what we have felt. And in fact, as Brian mentioned, we took it a step further and felt that there were probably other prospects that looked a lot like these folks. And so we looked at the unrated, unable to rate group in the Ds and Es and asked the staff, in addition to reviewing their own cases that fell into that orange box, we asked them to look if there were others that GG&A was unable to rate, but we knew something about them and thought that they looked and smelled just like the people in the orange box, should they also be recommended to come out of their portfolios. So I think from the orange box standpoint, we were not surprised. I think the green box, we were a little bit more surprised on the surface, because I think Yale's had an ongoing major gift effort for more than 20 years, and I think we know our pool pretty well. As we've dug in, certainly there are some surprises in that green group, but we found that more of those are people that we chose not to have in our pools for reasons. Again, there are some good names we found down there, but some of them, they had been previously assigned and we'd made decisions to take them out of the portfolio. In many cases, it's time to revisit that and decide should they go back in. But I think the most liberating and interesting for us has really been the orange or red box, which are people that I think we knew all along weren't great, and it was a chance to really look at them and take them out of our portfolios.
And to that point, let's just examine those two boxes for a little bit. On the green box side, the 1,560 households, that group had total giving of more than $80 million to Yale, average giving of about $51,000. But what was really important about this, because again of the comprehensive nature of the campaign and because it really was university-wide, that group of people had giving to or degrees from 19 different parts of Yale. They were not just focused in one or two areas. They were not just medicine prospects. They were not just college prospects. They were all over the place. And so that really was our first clue that the opportunity existed to make some fundamental revisions in portfolios, partly from Joan's point about the license to focus away from some of the prospects we've known weren't that exciting, but also to say there were opportunities for upgrade within the population from this group. On the low priority assigned prospects, just to put some numbers around what Joan was saying, when that population was distributed to development officers and they were asked what they wanted to do, and let me just say that was the important thing. They were asked what they wanted to do. There was no point in which the computer said you will no longer be assigned to this prospect. What we said was, here's some information about some people in your portfolio. What do you want to do? That on the first pass, 86% of those people in the orange box were dropped. There was even a second pass at which more of them were dropped, and then to Joan's point about the unable to rates, a significant number of those people were dropped as well. So at one point, we're simply saying to people, if you're going to be focused, let's stay focused within the people you already have on the best prospects, and let's clear out some people who might otherwise be less capable and likely than what we're looking for, and then how do we bring in some of these new finds that might be out there. So with this in mind, now that we had a basis by which to describe individual prospects, the key became, how do we start now looking at assigned portfolios? So what we do is we take the inclination ratings and the capacity estimates and we create a value for each prospect manager's portfolio. So the simplest way to describe value is a $1 million A-rated prospect is worth a lot more in your portfolio than a $1 million D-rated prospect is. They both have capability to make a $1 million gift, we believe, but one is significantly more likely than the other to do it, and as a result is more valuable in the near term in your portfolio. So what we wanted to be able to do was report portfolio value for individual gift officers, but also at unit levels. So we can start looking gift officer by gift officer, unit by unit, and compare that to where the campaign priorities were, understand where goals had been set and whether they were likely to be realized based on what was in a portfolio. And as I mentioned earlier, these principles, though there would be some tweaking involved in them, the principles of understanding the value of a portfolio also apply outside the major gift and principal gift realm, just with a few changes. So let me get to the ugly numbers. This has been very mostly words so far. So here's a set of numbers, and this chart will require a little bit of explanation. This is the group of people at Yale who are in the major gift team. Now, these are people who are focused on regions and college alums, basically, who are assigned at the level of major gift. And what you see down the gift officer name column, these are individual gift officers. We've obviously removed their names, but these letters are representative of individual people. And you see the number of prospects in their assigned portfolio. And let's just stop there for a second. You see some that are quite small, and there are reasons behind that. But if you look through most of these rows, you'll see that there was actually a significant uniformity in the size of major gift portfolios. Most of them were in the sort of 230 to 250 range. There were prospect management guidelines in place that said this is what we think a portfolio ought to have, and it had reasonably similar numbers of people within it. The next column I'm going to do very quickly, which is this is the calculated value of a portfolio based on each of the prospects within it. I want to focus you on the next column, though, because this is where you can see relative to each other what the value of portfolios is. It's an index, and what that index says is if you had a portfolio that was exactly the average value of all the portfolios, you'd have an index of 100. Any number you see above 100 means that you have an above-average portfolio. Any number below 100 means you have a below-average portfolio. So what you see here is that across people with largely similar sizes of portfolios, you see some dramatic differences in the relative values of portfolios. The person at the top has a portfolio that is 3.5 times, almost 3.5 times the value of an average portfolio. In the middle, where you look at development officer AZ, 260 prospects, and they have right about an average value of a portfolio. So there's big differences. Some people have 3 times as valuable a portfolio as others. That's not a problem in the sense that we don't believe in equivalent portfolios unless we had truly equivalent development officers, which tends not to be the case. But what it does do is it gives Joan and her colleagues the opportunity to say, do we have portfolios focused with the right development officers? The next column is the value of each prospect, and again, the column after that is the index. Again, that's the index of the average value of a prospect you have, and here's where you start seeing a dramatic difference. Most of the major gift officers, if you look at the people in their portfolios, their average prospect is below average university-wide. So that's telling us something interesting. What that's telling us is they've got a lot of people in their portfolios, but the average person in the portfolio doesn't necessarily look so great. The reason for that is largely embodied in the last two columns. This is the percentage of prospects who are A, B, and C rated in the one column versus D and E rated. So if you look at that top development officer who has such a great portfolio, 87% of that development officer's prospects are A, B, and C rated. She's working with a really good group of near-term, valuable, capable prospects. If you look down this list, you start seeing quite a few development officers who were 50-50 or worse between likely near-term prospects and really long-term prospects. As a group, this entire population was close to 50-50. If you see at the bottom there, 54% of the assigned prospects in major gifts were A, B, and C. University-wide, that number was 44%. So what we found when we looked at portfolios at Yale was, to Joan's point about we've been assigning people based on capacity only, that when we started looking at inclination, we saw a very different picture of what a portfolio looks like. Joan, I was wondering if you could comment a little bit on how this looked to you as someone with responsibility for major gifts.
Sure. So again, I think we probably weren't surprised by what we saw because we knew we had a lot of uninclined prospects. This just helped to quantify what everybody felt. So again, it was sort of a validation, which is a great thing to have. I think that one of the points that Brian just mentioned is the idea of being able to look at both the whole team. So if you take major gifts, do you have the whole team balanced the way you'd want it to, and do you have people individually balanced the way you'd like them to be? Are your more senior fundraisers with the portfolios that have more near-term and a higher value portfolio, or is it not spread out the way you'd want it to? So I think that's where we found a little bit more surprise, not completely. I think we did find that some of our more senior fundraisers had the portfolios that were the most valuable, and some of our newest folks had portfolios that weren't necessarily as valuable, and that we would have expected to see. Many of them had sort of prospecting portfolios. But it was a little bit in the middle, and it was how much we were weighting down people with prospects that weren't probably worth their time. So I think that this, again, really helped to quantify something that we felt, but we just weren't really sure how to get your hands around.
When we apply this same logic to two other groups, and we wanted to show you examples of two other groups, one being principal gifts and one being a school. On the principal gift side, what you see is an entirely different picture. So that's across the top there. The 5 principal gift portfolios are very small, very valuable, and very focused on A, B, and C prospects. So you see down those right-hand 2 columns, the lowest percentage of A, B, and C among that group is 80%. It goes as high as 96%. The principal gift team, very focused on a small number of likely capable prospects. In fact, upon seeing the caliber of the prospects in these portfolios, we've even gotten into a discussion as to whether we want to raise the floor of what is a principal gift, simply because even having 50 of these kind of prospects is almost an unmanageable situation because these are such valuable prospects. But then to take it to the next level, as we look at the law school, what's interesting about this is that the first development officer you see there, development officer A, B under the law school, that person's portfolio looks exactly like the principal gift portfolios. And that's because this really is a principal gift officer who happens to exist within one of the schools. Below that, however, you start seeing some real differences. So within the people who are carrying portfolios within the law school, take development officer BB and development officer BC. The first one, BB's portfolio, is twice as valuable as BC's. Maybe that's the right thing to do, maybe that's not. As we go further down, you start seeing people with portfolios that have an index of 19. That suggests that this portfolio is 1/5 as valuable as an average portfolio at Yale. And is this the right distribution of prospects and the right deployment of resources in order to make the campaign most successful based on the goals associated with the law school. And again, on the right-hand side, between the A's, B's, and C's and the D's and E's, you see some vast, vast differences. So I think this is an important opportunity. And again, this is part of putting everyone on the Yale campus on a level playing field and being able to discuss that. So Joan, maybe you could describe a little bit about how this was useful in bringing some of the professional schools and other parts of Yale together as part of the campaign and the analysis.
Sure. So I think one of the things that's interesting, again, in this campaign was one of the first times that we were really trying to staff up in some of our schools and units across campus and have a fully comprehensive campaign where we weren't just relying on Yale College prospects to fund the entire campaign. So in doing that, we had portfolios that were outside of major gifts and principal gifts that were broader, and therefore we have prospects that are being assigned probably by slightly different definitions. And I think what the analysis with GG&A was able to show us was exactly that we have portfolios that are more like a special gift or even an annual fund solicitation. Those cases, the prospects are assigned and they're in a portfolio, but they may not be with the same level of expectation on donor capacity, and so we have a little bit of apples and oranges within our prospect pool. If you use the law school as an example, it's a little bit of a microcosm. So you've got major gift portfolios and principal gifts and then some annual portfolios. What's interesting is for us to take a step back and say, okay, if this is how many resources we have at the law school or at any other school, when we looked at that green box, there were some law school prospects there who looked more promising. So one of the things that the law school is trying to do is to decide, are there people that had not previously been assigned who are better than these particular prospects, and should they do some rearranging to upgrade the quality of the prospects who are being managed? That may mean changing a little bit what people's description of their job is, but that might be worthwhile given the potential for those potential prospects pools. And again, back to that sort of, if this is how many gift officers we can have, how to distribute those prospects in the best possible way. So I think it helped us to understand that we needed to do a better job of having consistent language for how we defined our prospect pools across campus, and then decide how do we go about making the right strategic decisions then based on those consistent definitions.
So to take this to the next step, before we do that, I'd ask you to focus again on those two development officers I mentioned before, Development Officer BB and BC. So think about this. We've got two people who are working in the same school who have portfolios of significantly different value. At the same time, we don't yet have a mechanism for understanding what should each of those portfolios be producing between now and the end of the campaign. So let's move on to that, which is a prospect stage concept. Many of you have prospect stages. Some of you have ones that are used in different ways, or some used in certain parts of the institution and not in others. But it becomes very important once you start seeing how differently some of the portfolios are constructed that we need to be able to understand what's actually happening within these portfolios. Whether they're very large or very small, we're still asking for we need a way to look at them holistically and say what appears to be happening and what appears likely to happen in the near term. So at Yale, there was a stage model that was in place, and I think Joan would support the idea that it was used somewhat inconsistently. But nonetheless, I just want to show you one or two charts just to give you a sense of what's possible to understand through having this kind of an analysis. Across the top, what you see is the number of prospects. The next column is the percentage of prospects and the percentage of value down in the last part. And along the bottom, you see stages and groups of stages at Yale. So there's a cultivation stage. There's a scheduled solicitation stage. There are two stages that we put together called Ask, Made, and Follow-Up, and then several stewardship stages. What you see from this is that based on, at least on this snapshot, there were relatively few prospects and relatively little value that were in the scheduled solicitation or Ask, Made, and Follow-Up phases. And what's challenging about that, again, if we think about 2 years to go in a campaign, is is there a real momentum toward finishing strong with the portfolios that we have and with the prospect management that's in place? So this is at the aggregate level. This is just one school just to show you how this works. This is for the business school. What you see out of this group is interesting because if you look at the center, you'll see that 15% of prospects are in scheduled solicitation, but that only represents 11% of the value of prospects. That suggests that the people we're about to ask for money are below average prospects. It's not entirely surprising if, in fact, if we think about the campaign status and say most of our best prospects are in stewardship because they're still paying off the pledge they made at the beginning of the campaign. And that's exactly what you see, that 31% of the prospects, but 44% of the value are in stewardship. The challenge then becomes, how do we develop the strategies that bring prospects in stewardship back into the cultivation cycle before the end of the campaign? Or if that's not possible, how do we bring in more likely prospects who we can move quickly to that stage? So this is about saying, all right, it's fine to know that these two development officers have portfolios of different values, and it's certainly useful for us in terms of setting our performance metrics and understanding our expectations. But we can refine that significantly if we understand where those prospects are in their movement toward making gifts. But because the existing stage model was not precisely getting at what management wanted, we knew we needed to create a new model that would more clearly describe what was really going on within portfolios and how prospects were moving. It was an extremely important piece, given the status of the campaign, to put time frames around this. And that's not something that had been in place at Yale before, was the idea that there's at least a notion of how long a prospect should be in a certain stage. Nothing was designed to create, again, a mechanical process that said, as of this date, you're in trouble. But it was to say, how do we start tracking whether we are effectively moving prospects along? Because we all know that cultivations can stall, and if they stall, they become much less likely to deliver the gifts we know prospects are capable and interested in making. What we knew the new model needed to be was a couple things. First, simple. More focused on prospect movement and less on proposals. And this is something that I will comment that we see quite often across a lot of institutions, is that they have good proposal tracking systems. We know where a proposal is, but we're not as good at pulling the camera back a little bit and understanding the movement of the prospect before we get to that proposal. And we wanted to have a system that would enable us to describe in a common way what was happening with prospects, not just proposals. And it was universal enough to be implemented across campus. And in the Yale's environment, as in so many, we've got medicine, we've got professional schools, we've got undergraduate, we've got alums and non-alums, and we know we've got different things that are happening. We wanted to have a system that was flexible enough to accommodate all. What you see here is a stage model that is in the process of being implemented at Yale now, and Joan will comment on this in just a moment, but it starts from identification and qualification at the beginning, moves through cultivation stages, solicitation, close, and gets to two different types of stewardship. Now, there's no assumption that prospects move in a completely linear way through this. It's written in a linear way, and that may be kind of the textbook view of how things work. We all know that's not actually how things work in all cases. But at the same time, being able to comprehensively describe the stages of prospect management in a way that development officers could apply a consistent definition became very important. Below those boxes, you see the time frame, and you see just a short kind of question that we're talking about as part of a definition. There are more robust definitions behind this so that these prospect stages could be implemented more consistently across campus. Joan, would you share a little bit about what it's been like implementing this kind of a process across Yale?
Sure. So we haven't implemented it across Yale, so I could start with that. But let me take one step back to say that the stage model we had was created only about 1.5 years ago, and it was really more of a solicitation. As Brian said, a lot of times they're proposal models. Ours was clearly more of a solicitation model, and we really only implemented it at the top end of donors and in a pretty centralized way. So it hadn't been broadly adopted, so it failed that universal enough to be implemented across campus. It didn't pass that test. but it also was so focused on solicitation. And so we were looking for something that we could adopt that made more sense. When we've got a group together and created this based on some recommendations from GG&A, but made some adaptations, because of where we are in the campaign, we couldn't help but have the campaign time frame be a little bit what was we were focused on. So the time frames that we put in place here made sense to us based on where we are in our campaign. We have rolled it out in terms of major gifts and principal gifts. I think people are finding that these definitions make more sense and that they will be more useful in terms of understanding how well they're able to really make progress with their prospect pool, and if they're getting stalled at certain levels. What may be happening, what's behind why they're getting stalled. Is it because they, as an individual, have too many prospects that are at exactly the same stage, so they're in this early identification qualification stage, and so they don't have enough prospects that have already engaged, in which case then we might want to make some adjustments in the portfolio? Or do they have so many prospects that are in advanced cultivation and headed towards solicitation that, again, maybe they're too heavily weighted in that area? I think people will find that those that feedback will be helpful to them when they look at it from a broad standpoint. I think from a management standpoint, we're looking forward to having this give us a better idea of what's coming down the pipeline, and do we have enough of our highly rated prospects that are moving through advanced cultivation and into solicitation. Certainly we don't want to see too many of our top prospects living in long-term stewardship. We've defined those as people that we think are done, maybe forever, but certainly done for the campaign, and there wouldn't be an opportunity for a resolicit. So it should give us a better sense of how much of our potential we think will be is moving through this model, and where do we think that they will be likely, what's the time frame that we think we'll start to see real movement in the solicitation and closure level.
And Joan, on the timing, you guys had a conversation internally about whether the time frames on here are kind of focused toward the campaign, and maybe post-campaign they might be adjusted. Can you talk about that a little bit?
Yeah, when we looked at these, we really felt like this was the time frame that made sense for the campaign. I think we fully expect that post-campaign we'll take another look at this. We like the definitions, the triggers, the words that defined how you moved from one category to another, but I think we fully expect, we put 6 months in for identification qualification because, again, in this campaign, if in 6 months people aren't moving out of there, we probably need to decide that unless they're a really top-rated prospect and in our sort of principal quality, or at least let's say $1 million quality, that at some point we need to take those other prospects and not pay attention to them during the rest of the campaign if after 6 months we can't find a way to engage them. We might decide post-campaign that should be a different length of time. And then the same in the early and advanced cultivation. I think we feel like we should be able to move those cases through at a pretty rapid rate using the time frame of the campaign as an impetus. Once the campaign is gone, we know that we'll probably need to slow down some of these pieces at various levels. So we would plan to regroup and kind of discuss what makes sense in terms of time frames.
Okay. We're going to move into the last section, which is the last couple slides talking about the impact of this, and then we'll move on to questions and answers. We've received some, and I guess I would just encourage you, if you're thinking about questions, this is a good time to type those in now, because we'll be coming on to those in just a couple minutes. Obviously, project impact is very important, and it's very difficult to assess in real short periods of time, and we're still, this is always work in progress, and that's the situation that we're all going to be in. But we wanted to share with you just a little bit, some of it math and some of it not, about what the impact of this has been. So let me walk you through a little math exercise. I apologize in advance if anyone's glazing over at the math, but here we go. Just to make the example of what focus can do. Across the top line, what you see there is that among the current assigned prospects, if you think back to that first chart of numbers that we showed, there were 9,725 assigned prospects. And if you added up their total value and you looked at the average value of those prospects, it was about $165,000. The subset of that, the 3,155 who were in that orange box, the low priority assigned prospects, their average value was $3,000 per person. If you go to the next row, it is just the first one minus the second one. If all we had done was take out those 3,155 prospects, we would be working with nearly a third fewer people. But the average value of a prospect we're engaged with, because we took out all those low-value prospects, has jumped up to nearly $250,000. Focus matters, because time spent with lower-value prospects is time you're not going to get back with higher-value prospects. Now, if we actually add back in the high priority unassigned prospects, those 1,560 prospects who have an average value of more than $75,000, what you see is that in total, in the aggregate, if you look at the last line, we're engaged with 1,600 fewer people, but our average value of a prospect under management has gone up by nearly $50,000. Fewer people of higher caliber, of higher likelihood, higher value, gives development officers more of an opportunity to realize the results of the campaign, the potential of their portfolios in the near term. So to Joan's comment about license to focus, what we've really done through this process is give people the freedom to say, I have people in my portfolio that I am spending time with who I don't even think are as good as some others. I can replace those with some better people. We can have some tracking and measurement mechanisms in place to understand how that's working. So I'm going to ask Joan then to talk about some of the behavioral and sort of the operational pieces of what's changed.
So I think as the numbers here indicate, so prior to the portfolio analysis, we had 44% of our overall prospects were assigned A through C. And afterwards, we've gone up to 60%. I think that number will continue to go up as we are adding in more of the currently unassigned prospects. So again, those are the ones that are in the green box, the ones that have high potential. One of the pieces of advice that Brian had given us was not to dump those into the portfolios right away. It's more than you can really absorb. So that process is taking time, and but I think it will continue to increase the value of the portfolio. If we look at major gifts as a subset, that prior to the analysis, we found that we had 7 of the portfolios where half of their portfolio were below the A through C level, and now they're, well, at least as of when we created this slide, there was 1 that was less than that. My guess is that one doesn't exist anymore. So we really have been able, and largely by just taking out the lower quality prospects, we've really been able to increase the quality of the portfolio significantly. In the schools, in general, the quality of the portfolio in the A through C were not as strong, in part because we had a lot of schools where this is the first campaign for them for Yale. So the School of Management, it's the first capital campaign we have. And so many of the donors do not have a strong track record of giving. And so they look like they're less inclined donors. So they have more donors that are outside of the A through C range. But when we started this, we had only 2 schools. We had 2 schools that had portfolios more than 40% in the A through C range. We're now up to 5 schools that are at that range. So I think we've been able to, across the board, really focus on how we can take out cases that we shouldn't be focusing on, and then look more strategically as we add cases back in for those high-value prospects. As I mentioned, we're in the process of implementing the stage model. It's currently being implemented in the central development and major and principal gifts, and then we'll be adding it in the schools and units across campus. We're trying to figure out how to do it where it doesn't create a giant administrative burden for people, because we want this to be a helpful tool and not a burdensome tool. But I think that we're excited about it, in that I think both the quality of the portfolios and the ability to kind of measure how we're doing gives people a better feel for how they're focusing their effort. Seeing change in their stages of their prospects should be able to give people a sense that they're making progress, and that progress isn't just about solicitation and closure, but also that they're getting people engaged and moving them through the cultivation, so that we can really see improvement and progress in a portfolio. I think it's particularly important, if we look at more than just major and principal gifts, but in some of our schools and units where It's clear that this capital campaign is important, but it may be the beginning of a fundraising effort, and actually for many of them their campaign will continue post-campaign. So what we're doing now is trying to build the portfolios for them, and so they may find that they end this campaign with many of their prospects still in the cultivation stage, but they'll be then in a better position to continue to move them through solicitation and closure, but they're newer prospects in their involvement and in their engagement. So I think we'll end the campaign, as Brian said, with a portfolio that, with a pipeline that is more full so that we don't have that huge drop-off post-campaign. We all know that our institutions expect us in campaigns to reach our goals, then maintain that level and continue to grow it from there. So I think this will give us more tools to make sure that we're keeping the portfolios full post-campaign as well.
Okay, thank you all for your questions. I'm going to pick out a couple of these and throw them mostly to Joan, though there are one or two in here that I can't resist commenting on myself. So Joan, let me start with the first one that we've gotten some question around, which is how are fundraisers evaluated and how does this process tie into that? How are you using the information from the portfolio analysis and the stages in order to help determine performance among development officers?
So we've always evaluated fundraisers on more than just the money they raise, but on activity that they generate within their portfolio. But I think when we're burdened with too large a portfolio, then it's easy to kind of scratch the surface and do a lot of contacts with people, but you may not actually continue to move the case forward as much as you should. And so the stages, the combination of continuing a lot of the activity measurements that we've had, but being able to see then how are we moving prospects through the stages to understand, are we seeing a lot of people that are in early cultivation and never moving, then that is not as desirable as moving people from early cultivation to later stage and then into solicitation. So we have metrics for how much time we want people to be spending with their prospects and solicitation goals that are tied to end results of dollars that come out. But this will help us have more measurements, as I said, so everything's not just tied to solicitations and closures, but also movement of prospects through the prospect pool. One of the things that you, Brian, have told us to really focus on is that the pool should be made up of people that people can make movements with, that they can make progress, and that if you have someone in your pool, it should be because you're going to do something with them that moves them from that early stage through the stages. And if they don't move, then they probably shouldn't be in the portfolio anymore. So I think by getting the pools to be at the right level, it'll be easier to use that as a test, and that then over time we should also be taking people out of the portfolio if we're not making progress with them.
Well, that ties into another question that we received in a couple of different forms, which is this process of people being removed from portfolios. I guess I'd ask you to comment in two ways. One, sort of culturally, on the idea of dropping people when, or the perception of dropping people when in fact many of them are very nice, capable, people who we've known for years. And secondly, where do they actually go? When someone comes out of a portfolio, how is Yale handling those cases going forward?
So we're still figuring out some of this, but one of the things that we're doing is creating opportunity for more, I have a tickle in my throat, so I've had a cold, for more personalized attention in a couple of different areas. So more personalized attention in planned giving and more personalized attention in the annual fund. And by both augmenting our staffs a little bit, but refocusing the staff in planned giving and in the annual fund to be able to take some of these prospects who should come out of the major gift pool and shouldn't be handled necessarily as a one-on-one relationship, but handled more personally than they might have been previously in the annual fund or in planned giving. We hope that that's an opportunity to have another place that people can go, get some more personal attention, and maybe develop as a stronger annual donor or develop as a stronger planned giving donor. We didn't really have those avenues in the past, and that was probably part of our logic as to why we kept people in our portfolios, because we weren't really sure where they were supposed to go next. So that's, I think, will be the most specific kind of next step will be that people do need to come out of our portfolios. They may be great people, but if we really can't move them toward the solicitation of a top gift, a major gift, then we need to look for another place that they should be handled. There may also be a subset of people who are really strong stewardship cases, and we're not sure if those should then live in the portfolio or should live somewhere else. But I think for us to know that if a portfolio is made up of a large number of stewardship cases that we don't expect to make additional gifts, then we need to know that, because we expect that portfolio then to generate less in new gifts. And so we need to at least understand that and decide if that's the right decision. Can we afford to have that person doing that, or does it mean that we're leaving other prospects unhandled, or whatever management decisions we can make around that?
Absolutely. One of the questions that came in, and I'll take this one first to give you a chance to get a drink and then throw it back to you. The question was, how often should a portfolio review be completed? And I guess I want to challenge the notion that this is a project. It's a process. And in our view, once you undertake the idea that portfolios are in fact manageable and trackable, it becomes a regular part of the management process. And so our view is that once you do this, once you have this kind of a vocabulary for describing portfolios, you're in a constant state of evaluation and management. You're looking at movement through stages. Your people are coming out of portfolios and coming into them on a somewhat more regular basis than they might have in the past. One of the reasons that we see a lot of institutions with portfolios that have gotten very, very large and not well focused is simply that people go in and they never come out. And what we know we need to do if we're going to enforce our prospect management guidelines and keep focus is to be able to make those hard trade-off decisions that say, I really want this new prospect we've found, but I probably need to drop somebody in order to create the room for that. So, Joan, let me throw this to you and say, can you talk a little bit about, you guys have a system of dashboards and management reports that help you to do this as part of an ongoing management process. Can you talk a little bit about that?
So we do, but I think it's not as formalized as it needs to be. So as prospects are identified that could come into a prospect pool, we have a process for them being integrated into, for example, major gifts. But we've never had the rigor of saying, we really want your portfolio to be, let's say, 200 prospects. And so if you're going to take on these 5 new prospects, we know by our dashboards that you just took on 5 new prospects, but we've never had the rigor behind to say, so let's look for 5 prospects that should come out of your portfolio so that you don't have that constant swelling. So that's something that we are planning to be able to have in place with this. So we do have a good ability to know who's in a pool and exactly how many prospects are assigned to different people, and we have the conversations that happen to move them from one group to another, from the annual fund to major gifts, from major to principal, but we don't necessarily haven't in the past had the rigor to know, okay, if we want our pools to stay at a certain number, we've got to figure out who should not be in that prospect pool to make room for new prospects. One of the things we're really hoping is to really strengthen that process of prospects moving from one group to another, and as you said, make it less of a annual review, or but to make it where it's clear that if people are being worked in the annual fund and they're top prospects, that they should be moved into a major gift portfolio, that's a very fluid process that happens very easily, and in the same way that there are prospects that should move out of the major gift portfolio into the annual fund, or that should become principal gift prospects, that becomes a simple process, and that the staff are empowered to help make those decisions and those recommendations.
Okay. Thank you. Thanks to all of you for your questions. There were quite a few more than we could actually get to in time. We will certainly endeavor to respond to each of you who sent us questions, because I think there's some very good conversations to be had around some of the other topics that were raised. I just want to remind everyone that the recording of this webinar will be sent to each of the participants on Monday, so those of you who were not feverishly scribbling notes, you'll at least have this to go back to and review. Again, on behalf of Gigi and and Joan and the Yale team, we thank you all very much for participating in this webinar, and we look forward to future webinars that you can check your email for. We will have more topics like this coming up in subsequent months. Thank you all very much.